Hello everyone, this is Tim Leveroni. Joining me today is Samir Shah. We want to thank everyone listening to this market update call. Our goal is to educate you on the market environment and share perspectives from some of the investment managers we recommend. Shortly, I will introduce our partner, Jeff Bookbinder. He will present LPL Financial's outlook on the current market environment. If anybody has any questions, please call or email us. Jeff Bookbinder is Vice President, Equity Strategist, and Portfolio Manager at LPL Research. Okay, Jeff, take it away.
Great. Thanks so much, Tim. Thanks, Samir. It's good to be with you again. The presentation I have for you today is broken down into 4 sections that you see here: policy, economy, fixed income, and equities. Probably got a little more policy than anything else. Certainly, we're getting a lot of questions about the election, so I'll weave in a little bit of that as well. You'll probably get the least from me on fixed income. My title is Equity Strategist, and so frankly, I don't usually have a lot to say about fixed income. I'll probably do that again. So if we go into the first slide in the policy section, what this shows you is the amount of fiscal stimulus that's been put into the U.S. economy as a percentage of gross domestic product. And by fiscal stimulus, we really mean tax cuts that President Trump put into effect in late 2017, and then government spending, just through the annual budgeting process. Certainly a lot of defense spending in there, but other things as well. And so when you do the math, how much additional fiscal stimulus was put in as a percentage of the economy, you can see here this big bar in the middle is 2019 projected. About 2% of the economy was added in stimulus. That's really big. But we haven't really seen economic growth, measured by GDP, expand any faster than it did before the stimulus was put in place. It did for a very short time last year, but right now we're back to this trend economic growth of about 2%. So why has that happened? Well, the biggest reason is the trade war with China. So if we can continue to make progress, we have made progress, but if we can make a little bit more, we would expect economic growth to benefit, and some of the stimulus that was put into place in the last couple of years can begin to flow through. The stimulus isn't gone, it's just being offset by the trade risk. So, the next slide shows you the trade deficit. Of course, this is important to President Trump, trying to get this down. He's made a little progress, but really the more important factor, I think, here is around intellectual property protections. China stealing our technology, and around just fair trade, right? We all pretty much generally agreement that China is cheating and not playing by the rules that have been established. And so this is a very broad conflict that involves much more than just the trade balance. China is certainly buying more agricultural products, and they'll probably continue to do that, and that's great. But there's a lot more involved here. So I think the key takeaway on this is that you'll probably see a few more rounds of tension, but the election's coming up, as we all know, and China, certainly President Trump doesn't want to damage the economy too much with further escalation and damage his reelection prospects. So I think the key takeaway here is the election will prevent the Trump administration from doing too much more damage to the economy. They might do a little bit more, but as the election approaches, I think they're going to give in, and we'll come to some sort of a deal. Both sides know that the other can inflict more pain, right? If China really wants to ratchet up the pressure on the U.S., there's certainly a lot of things they can do. They can make it very difficult for companies to do business in China, for example. And then certainly if we stop buying Chinese goods, or we have companies pull out of China, which Trump has tried to do, tried to get a lot of businesses back to the U.S. That can certainly inflict more pain. Both sides have a lot of leverage here. And if you think about a reasonable outcome here, given the pain, given the interdependency of the two countries on each other, I think we're going to get to a deal. So,
Jeff, if I may, so how much of this is being priced into the markets?
Yeah, I think the markets are pricing in optimism, frankly. We're right around record highs. Stocks are, not cheap, not super expensive, probably fair to fully valued by our estimation. And so, yeah, there is optimism. I think that optimism is well-founded. I think we will continue to see progress. There's going to be a lot of pressure on President Trump to get a deal done in November, a mini deal. And then if some of these tariffs that he has already threatened actually come into effect in December or in early 2020, that's going to do more damage to the economy. The president's advisors, economic advisors, including Larry Kudlow, are putting a lot of pressure on him to make sure that he doesn't do too much damage to the economy. It's a really, really important issue. So we'll continue to follow that. This next slide basically answers the question, is the Federal Reserve going to cause a recession? We don't see a recession in the next 12 to 18 months. And one of the reasons why, there are a number of reasons, but one is because the Federal Reserve is cutting rates. And this chart tells you that they're not too tight. This chart shows the interest rate that the Federal Reserve targets, so that's the Fed funds rate, and then subtracts inflation. So we call that a real Fed funds rate or real policy rate. The shaded areas on the chart show recessions. This line, this statistic rises right before recessions, at least based on the last 5. And it's actually been around 2% or higher in each case. So right now this thing's about 0. It's actually slightly negative because the Fed funds rate is between 1.75 and 2%, and inflation is right about the same, a little higher if you use CPI. So you do that math, you get to a slight negative number. That means the Fed is actually in a pretty decent place, or even accommodative with their monetary policy, not tight enough to cause a recession. They may cut a couple more times, and this case would even be stronger, but certainly this doesn't look like the end of the economic cycle. This slide, this shows the dollar index. The first observation that we would make by looking at this chart is that even though the dollar is strong, and you've probably read about this in the news, it's nowhere near as strong as it was in the late 90s or the 80s. So we've been here before. The other thing I would say about this chart is we have a long-term downtrend, and while the last decade has interrupted that trend, we think we'll get back on it. And when the dollar's weak, that helps trade. That's why a lot of countries internationally are trying to weaken their currencies with central bank accommodation, right? With aggressive bond buying and aggressive rate cuts and negative interest rates and all of that. A lot of countries trying to weaken their currency because it helps exports. So the dollar has started to weaken a little bit recently. We think that is the start of a trend. We wouldn't say it's going to drop meaningfully in the next month or 6 months, but just the drag from the U.S. dollar is probably going to lessen. That's also good for corporate profits because U.S. companies generate a lot of profits overseas, and it's also good for international equity market returns because those get translated back into weaker dollar. So dollar's been a little bit of a drag. We expect that to lessen. So here are our economic forecasts. In the U.S., around 2%. That's kind of the trend that we've seen for the past decade. If trade goes well, we could do better. We're growing faster than Europe and Japan, quite a bit faster. In fact, Germany is on the cusp of recession. Emerging markets, this forecast, 4.1% for next year, I think that's too negative. That's an IMF forecast. Bloomberg's consensus is 4.5%. So we think EM growth will be stronger than the developed world by quite a bit. And we also think the trajectory of emerging market growth will be pretty stable compared to the European economies and Japanese economies where we're actually seeing a slowdown. The U.S. can probably hang in there and have, we'll call it, a pretty flat trajectory with recent years. The economy is going to be driven, we think, by the consumer. It'll continue to be driven by the consumer, which remains very, very strong. And if we get progress on trade, we think we can get more capital spending, more capital investment, which would help the economic growth outlook. And then inflation, not really a problem at all. This next chart, don't pay attention to the data in the upper right-hand corner. One of our data partners just put this in here. All I want to point out here is that productivity, which is how much output you can produce per hour worked, productivity is increasing, and technology is a big part of the reason why. And we think this is one of the most important things to watch in determining how long the economic expansion goes. It's already the longest economic expansion ever. We think it can go, potentially, a few more years. If we can continue to drive productivity, that means we can grow the economy without much inflation, right? Because if you can generate more growth without hiring a lot of people, then you don't have a case where wages are bid up, right? And if wages get bid up because there's a shortage of labor, that's when the Fed gets nervous and starts to hike rates, and historically that has been the end of business cycles. So productivity, very important to watch. So we'll do quick fixed income comments here, and then I'll get into equities. Yield curve, for those who don't know, it's just the difference between short-term interest rates and long-term interest rates. This has got a lot of attention because long-term rates had fallen below short-term rates, which is unusual. And historically, when that happens, we have had a recession roughly 12 to 18 months later. We do not expect that pattern to hold this time for a few reasons, but one is the low interest rates overseas, or negative interest rates overseas, are putting downward pressure on our rates. So our yield curve is being distorted. Another reason, which I'll get to in a couple of slides here, is the credit markets are really behaving well, right? When the credit markets tell you a recession's coming, they have a pretty good record, and they're not sending that signal now.
Yeah, and Jeff, if you could take a step back. You mentioned negative interest rates. Can you just explain what negative interest rates are?
I was afraid you were going to ask that. It's a very difficult question to answer. I'll tell you this. Certainly, consumers generally are not paying to lend, right? Just because the Federal Reserve, well, not the Federal Reserve, just because the European Central Bank or the Bank of Japan has a negative rate, that doesn't mean individuals are experiencing that. Now, some are. There were headlines overnight about Switzerland. Big, wealthy institutional clients are having to pay to park their money. We talked about this a little bit at your event last night, Samir and Tim. Essentially, pension funds, big institutions, banks, right? They're forced to hold capital, essentially, at the central banks. So they are forced to pay those negative rates. There are some waivers in the European market, so they don't have to do that. But by and large, traditional institutions like traditional corporations, traditional consumer borrowers aren't experiencing those negative rates. So it's really more of a psychological signal, trying to directionally show that these central banks are being very aggressive, but practically it really doesn't affect day-to-day lending. I think that's probably how I would put it. Now, when they unwind these negative rates and we go back to positive down the road, maybe there will be some risk because we haven't been here before, right? 10-year yields haven't been negative before in Germany. Actually, they haven't been negative in Japan based on the records that we have either. So, yeah, it's different this time. I won't totally dismiss the risk, but frankly, we're not particularly worried about negative rates causing some sort of systemic stress in the banking system right now.
And along that note, it is worth realizing that globally, meaning every economy, every country on this planet, 80% of all the debt is below 2% interest rate, which isn't normal.
Not at all. Not at all. There are structural forces putting downward pressure on inflation, but for not hundreds, probably thousands of years, economic growth and inflation have driven interest rates. We can't have a disconnect between economic growth and inflation and interest rates forever. So I don't know when it reconnects. It'll probably reconnect at a lower level than what we're used to historically. So I don't think we're going to go back to 6% interest rates being negative or being normal anytime soon. But we'll probably get to some sort of 3 to 4% range as being normal eventually. But there are a lot of structural issues, especially in Europe and Japan, that will have to be sorted out, and it might take a decade or two to do that.
That it's demographics and technology that's also keeping rates low as well.
That's right. The aging boomers in America buying a lot of bonds, that is certainly a factor. We have negative demographics in Japan. Even China is a little bit worse than we are. So we need the millennial generation globally to expand and grow and invest and work and all of that, and then maybe we can get back to normal. But yeah, we're in a little bit of a digestion phase for the aging of America and similar overseas. That's a great point. So I'll breeze through these next couple slides. So yes, the yield curve inverted, and people are worried about that. Even if we expect that to signal the end of the bull market, we've got time. This chart shows you that on average, it's more than a year before the S&P 500 peaks. So, we just inverted the 2s, 10s in August. So, that tells you through the election, if this holds, that stocks can continue to rise. And then, the gains have been solid, right? These are sort of traditional late cycle gains, 20% plus on average, with some really strong periods in the late 80s and late 90s. So, it's very reasonable to think we can go up high single digits from here before we peak. We think we've got another run left in stocks before the bull ends. This slide just shows credit spreads being calm. I mentioned that already. By the way, another reason the yield curve is not particularly worrisome is because the inversion was so short-lived, right? It was shallow and short-lived. The more powerful signals historically have been deeper inversions, and they've lasted a while. Those are the ones that have led to recession. So that's another reason to be somewhat comforted. Turning to stocks, so this just shows the S&P 500 over last year. We're a little above this, where I priced this chart around 29.90, give or take. So the 50-day moving average in the black line has actually started to turn back up just barely, and then the 200-day moving average in yellow is certainly positive sloping, and the index is above it. Those are positive signals from technical analysis that suggest stocks have good momentum, and that momentum is likely to continue. And it also suggests that if we have a pullback, which we will, we always have pullbacks, it could be pretty modest. So we think, maybe we'll go down 50 points, maybe we'll go down 100 points, but it's going to take a lot of bad news, we think, to get us below 28.50. So that's sort of 5 to 10%, not even 10, 5 to 7% kind of a pullback is reasonable to expect between now and year end, but we think the odds are pretty good that we avoid it, or we have something more modest. One of the best reasons to own stocks, I think, right now is because the Fed's cutting rates. I alluded to this earlier. When the Fed cuts rates and you don't have recession, you see here, these are the 5 sets of bars on the left. Those are all nice gains. We're talking about, on average, 10% gains 12 months after the Fed starts cutting rates. Of course, the exception is if you go into recession. So, if you think we're going into recession, like 01 and 07, then that says the Fed's behind the curve. They won't be able to stop us. We're going to drive off into a ditch. That is possible, but we think, again, very unlikely. We look at a number of leading indicators. Certainly, you, Tim, you, Samir, you guys look at a lot of leading indicators that tell us where the economy might be going. It's really hard to find one that's telling us we're going into recession. So we're operating under the assumption that we're on the good side of this chart. Stocks up over the next 12 months. Then the next slide is a similar concept. This looks at Fed rate cutting cycles when you've had 2 cuts of 25 basis points. So they cut a quarter point, then they wait, and they cut a quarter point again. That's what we just had. In all those environments, and there's 5 scenarios here back to the late 70s, stocks have been higher in the subsequent 6 months and the subsequent 12 months. So this, we think, and you see the average for 12 months has been really strong, right? 16.7%. So following this pattern would be very positive for stocks. You may have heard, "Don't fight the Fed." That is an old market adage that we believe in. The historical patterns suggest stocks go higher on the Fed. So the last chart I have, and then we'll get to the important disclosures, is earnings. And so earnings season's going on right now. We're probably not going to see any earnings growth this quarter, probably be around flat, and that's not good. However, what is good is things are looking brighter going forward, right? And these are consensus estimates for earnings growth for the S&P 500 going forward, shaded area from Q4 on. You see we expect earnings growth to accelerate. Now, it might not accelerate quite as much as you see in this chart. Estimates tend to come down over time before those quarters become actuals and are reported. But we think the conditions are in place for better earnings growth ahead. And trade clarity will be one big reason why. We think we're going to get it, and that'll allow businesses to invest. And earnings are really driven by business investment. They're driven by the consumer too, but business investment and manufacturing drive earnings more than consumer spending, even though consumer spending is a much bigger piece of the U.S. economy based on the GDP calculation. Think about business investment. Think about manufacturing as really important here to earnings, and we think that the conditions are in place for those to get better. So better earnings ahead, even if we only get trend economic growth right around that 2%. If we get some tariff relief and, frankly, not too much wage growth. We want wage growth. We just don't want it to accelerate too much that scares the Fed. That can certainly be good for corporate profits too, because of course the companies that hire people have to pay the wages. So that's all I had to say on earnings, and we'll certainly be following earnings season closely over the next several weeks. We just gotten started. It's been a decent start so far. Hopefully we'll have a better finish. So that's it. Let's do the disclosures, and then I'll turn it back over to you guys, Tim and Samir.
Yeah, Jeff, if I may, a lot of what you said is great. There's definitely a lot of reasons to be uncertain on the policy side, political side, as well as the markets. But one thing that we try to do is just try to focus on the fundamentals, which you clearly articulated. But how we manage through all the uncertain times is making sure our clients' portfolios are divided based on their needs. We try to allocate their monies into the 3 buckets. We follow the 3-bucket approach, making sure that the cash needs are defined so that way they don't have to worry about the uncertain times. So everything you said, we appreciate.
Well,
Thank you,
thank
Jeff.
you. Thank you for that.
Yes, thank you again, Jeff, for your thoughts on the current market environment. As a reminder, if you have any questions, please contact us by calling 781-848-9821 or visit us on the web at www.leveroni.com. That's LEVERONI.com. Also, we would like to hear some feedback to help us improve the format of these calls. And if you know of anybody who would be interested in hearing our market update, you can forward this email to them. Thank you for your continued confidence.